We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. You can always go to the website to learn more. That is deckerretirementplanning.com, deckerretirementplanning.com. And I always start the show this way because there's so much information they have available for you. If you'd like to learn more about retirement, more about what's going on at Decker Retirement, you want to know more about retirement, you can just get Brian's book. It's part of, if you go to deckerretirementplanning.com, under the heading of Safer Retirement Education, there is a group of 12 different things at least that you can download, any or all of it. It's just all there for your information. Brian's book, the Decker Approach Book of Retirement, the 3 Principles of Retirement book. There's a checklist challenge, about 35 things you need to check. And if you could check all of them, you're probably good to go. And then there's a sample income plan. Those are just 4 of the 12 things you could download. Again, that's deckerretirementplanning.com. You can learn more about Brian, Brad, and the team, but deckerretirementplanning.com under the heading of Safer Retirement Education if you'd like any, or download all of it. It's your choice. If you have questions from anything we talk about today on the program, or you just have your own questions. Boy, am I invested the right way for what's happening right now? What happens if the Fed does, lower the interest rates in September? How does that affect us? 833-707-3030 is the number, 833-707-3030. Brad, welcome. Brian, what are you guys going with today?
Well, we're going to talk about how nimble and adaptable we are in a changing market environment. The Fed might lower rates coming up in their September meeting. The expectation is that they will, quarter point. What will that do to the savings rate, the money market rates? When you're a mortgage holder, you want rates as low as possible. When you're a business owner and you want to do business, you want rates as low as possible. That's why markets go up, they like lower rates. But when you're in retirement, you want rates high because that's your savings rate, that's your CD rate. So we've got Brad here to talk about a big change that we've made. And Brad, you can roll out the details. I'm proud of us in what we've done, because as an independent company, as a fiduciary to our clients, we're going to explain something that we've done that I just haven't heard other companies doing. So Brad, tell us about it.
Yeah, it's called our Cash Plus portfolio. At least that's the term where we've been kicking around in-house. I think it came, going back a little while, probably longer than I need to, but during COVID, which, forever ago now it feels like, but still fresh in my mind. I just remember coming across portfolios that just were overweight cash. People just didn't. They stopped spending. They started accumulating cash balances from checks that were deposited from, say, Social Security or pensions or just unspent funds. And that cash built up. And I still remember sitting across from people in 2020, 2021, and just talking through the embarrassingly low rates. This was money that people purposely had as safe and liquid. They wanted to keep it available, not subject to the whims of the market. And I think also at the time, it ended up being pretty productive years in the stock market. It was money that people weren't really looking to risk in equities. And just got us thinking here at DRP, is there anything that we could do that's better? Because if anybody remembers interest rates at the time, it was before the Fed started really cutting rates. And Brian, what were some of the rates you saw 2020, 2021 for people's discretionary cash, emergency cash, even bucket one? Do you remember those?
Brad, I do remember that like it was yesterday. It started with a 0. So the 10-year Treasury was 0.47. The 10-year Treasury was at 0.47.
Yeah, and while I know that the Treasury has some tax benefits to it, imagine that after taxes too. So for a non-qualified account. So in that environment, it was tough. There's no value anywhere. Now things completely switched in 2022. We started to see 40-year high inflation, and I just remember doing the same show and addressing just what was first time in my career, my professional life, experiencing that kind of inflation after many, many, many years of near zero or zero inflation. I mean, I remember people talking about inflation having been gone away and it no longer was going to be an issue. And of course, they were wrong. And that's when the Fed jacked up rates and rates just went to the moon. And after having so many years, so many years of just extraordinarily low interest rates, it was really easy. I mean, it was so easy when people came to me with funds and they just wanted to know where to put their safe money. They wanted to keep it liquid so they're not trying to get long-term protection here. We're not looking for long-term volatility and growth. And 2022 is a piece of cake. I mean, there's savings accounts paying 5.5%, much less anything with like a CD or something. I mean, there was some yields. I think I even cracked 6% one time on one particular fixed rate for, I think it was a 5-year. And just remember, man, this is going to end at some point. I don't know when. And like you said, Brian, market's predicting we're coming to an end. I think a year ago, we all got the shots across the bow and the Fed cut rates a couple times right around now. And but that was quickly halted as inflation started to curl back upwards. And there was some obviously perpetuated and uncertainty in April with the tariffs. And so the Fed's just kind of been in a holding pattern for a while. Hasn't indicated any interest in raising rates in that amount of time, but until recently has really been hesitant to signal any cutting of rates. But here we are, September, expected rate cut unless new data comes in. It'll probably continue into October. And think about that far out, I don't really have much of an input. But those rates are going back down. And so, again, kind of a long foundation there gets us to where we've been thinking a lot about what to do with our clients' cash as we expect rates to start to normalize or revert back to their long-term average. Anything you'd add to that before we dive into the cash plus portfolio, Brian?
Yeah, let's talk about interest rate risk for a second. If you own bond funds in a rising interest rate environment, you're not going to like it. As a matter of fact, the average bond fund in the last 5 years since 2000 has lost over 35%. So when you have your safe money in bond funds, your advisor tells you to put safe money in bond funds, and you're in a rising interest rate environment, that hurts. So, Brad, we've been warning people about interest rate risk for over a decade, and that really paid off. We were on top of that one.
Yeah, right there with you. I mean, there's just no exchange for protection or we're drawing from a source of funds that are contractually or like structurally protected against losses if those funds are indeed needed for something. It's putting that purpose behind your money. That can be so helpful in having confidence that we can react or respond or tolerate anything the market throws at us. But we saw rates going up in 2022 and probably going to start to come back down. Well, anyway, that gets us back to prior to the rate hike environment because of inflation. We was just trying to chase yield everywhere. I mean, our risk assets did just fine because those are positioned for long-term growth and can tolerate volatility. But when people have a need for, let's say, a little bit more near-term funds or even immediate liquidity, but they still are trying to optimize it or at least keep up with inflation, that's the problem we're trying to tackle here. All right, it's not the funds that are used in a 7 to 15-year investment horizon. That's your risk bucket. It's not the funds that are drawn from systematically as you're harvesting dollars for monthly income or annual cash flow over the course of 5, 10 years or 15 years even. This is the money that you use as sort of your, from a business perspective, it's like your working capital. It's your dollars that you use for whatever life throws at you. Emergency cash, discretionary cash, and then what I think of as bucket 1, 2, and 3. Now, you've talked a lot about those on this show, but the hallmark of these funds is that, from my perspective, they're invested for less than one market cycle. And I think average market cycle 7, 8 years, 6 good ones, 1 really bad one. And when you have dollars that are used or intended to be, drawn from in less than one market cycle, we strongly recommend that people remove that risk of being on the wrong side of, let's say, 2008, unless someone's willing to make some compromises. So the cash plus portfolio for us, we're looking to see what we can do to improve on interest rates on what would objectively be safe money, like very low volatility, but do so in a way that provides a meaningful yield or more growth than what someone is going to be able to expect from a declining savings account rate that I'm seeing right now at like 3.5%, or even some of the money market funds we're using that are at 4. Those are going to be going lower soon. And I think we landed on it. just in the last week. It's taken a little while longer, Brian, than I know you'd prefer, given how fast you like to move on these things. But I think that our office did a great job of finding a pretty cool strategy that is going to provide a lot of value for our
Now,
clients.
Brad, go ahead and dive into the details. Now, the things that
Yeah.
we do, we consider our fiduciary responsibility very seriously. And so we use a database that lets us know what the highest earning principal guaranteed accounts are. We check it monthly. We want to make sure that our clients are getting the highest earning principal guaranteed money market rates. We make sure that they're getting the highest 3 and 5 year CD rates and 7 and 10-year rates as well. We're going to focus in on, would you say, Brad, you described it as anything where it's over 1 year? Is that how you describe this?
Kind of depends on the individual. I really think of it as any dollars that someone is using in maybe a 1 to 3 year time frame, 1 to 5 year, or even 0 to 5 year. The low volatility nature of this cash plus portfolio is really is what gives me confidence that it's something that could be used in anything where liquidity is needed and someone is looking to draw from an account for 0 to 5 years, and then ideally kind of like a 1 to 3 year time frame is, I think, kind of perfect, because once you get a greater than 3 years out, probably could tolerate a bit more risk, a bit more volatility on those dollars. And if you get less than 1 year, then if there's a very long tail, very bad abnormal environment, there could be some volatility or losses there that might not be welcome. But bottom line, anything 0 to 5 years out, not long-term money, but not immediately needed, I think is a really good candidate for this type of a strategy.
Okay, Brad, how liquid is it?
100% liquid. No issues with immediate liquidation. I mean, you have your typical securities clearing laws. What is it, T+2 or something these days? At least for ETFs. We have a couple mutual funds in there where you have the end of day closing. So 100% liquidity, and that really is what's important here. Maintaining that liquidity on funds that are used for discretionary cash, emergency cash. Again, we call it bucket 1, and then even improving some of the liquidity that people might want out of their buckets 2 and 3, that 3 and 5 year money. So we'll talk about some trade-offs there.
So if you'd like to learn more about what Brad is talking about, and Brian, the Cash Plus portfolio, and does this make sense for you in your situation, it's easy to find out. All you have to do is give them a call and say, hey, I'd like to learn a little bit more about that. It's kind of interesting. They're going to talk more about this when we come back, certainly. But the number to talk with the team at Decker Retirement Planning is 833-707-3030. There's no cost to you. There's no obligation. There's no pressure. If they can help you, they will tell you. And if it's a good fit for you and it's a good fit for them, then maybe you'll become a client. But it's a two-way street here. They're here to help if they can, and then you need to want their help and can use their help. Basically, 833-707-3030, 833-707-3030. Brian and Brad back with more right here on Safer Retirement Radio. We're talking the Cash Plus portfolio. We're going to get a little deeper into it when we come back. Stay with us. We're back right after this.
Is the price tag on everything giving you sticker shock? From groceries to gas, the cost of living is skyrocketing. But if you think inflation is painful now, just wait till you retire. Ease inflation's impact on your retirement dreams by calling Brian and start preparing today. 833-707-3030. Again, that's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement, because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Again, the website to learn more is deckerretirementplanning.com. You can find out about events that they put on at the various offices. They always have something going on. And it's typically to help educate the people that want to learn more about the financial world, the retirement world, deckerretirementplanning.com. If you have questions, you have some concerns, 833-707-3030, 833-707-3030. I'm Mark Elliott. Glad you're with us. Brian and Brad diving into a new strategy they're putting into place. I think the Fed's going to maybe lower interest rates by a quarter point in September. We'll see. And that's what this is, the cash plus portfolio. Brian, continue the discussion. I know you're going to get a little deeper into this thing.
Okay, with the expectation that the Fed's going to be lowering rates next month in the September meeting by a quarter point, rates will go down. The expectation is that retirees are earning less on their CDs, their money market rates. We're doing something about it at Decker Retirement Planning because we run our own show. We're fiduciaries to our clients. We've done the research, we've done the homework, and we've created a cash plus portfolio, 100% liquidity. And Brad, here's the best news so far this hour. What's the rate, the average rate that you're getting on that?
Yeah, the rate we're getting on that is coming in right at about a 6.68% annual range midpoint, which we were pretty excited about because when you benchmark that yield on the against current rates, it did definitely provide some extra yield that we really like. Now, you'll learn this. The audience might know this about me already, but I actually think rates of return is actually my least favorite metric. It just gives no context into how that money is earned, the cadence that it comes in at. It's easy to compare side by side, but the comparisons often fall short. One portfolio might end up with a higher end result of total dollars, even though it has a lower rate of return. And that comes from the fact that maybe it just is, it's not losing as much, so it doesn't require as high of a rate of return. So I do like the yield, but I do want to encourage people to pay attention as we dive into why that yield is actually pretty meaningful, and not just compare that 6.68 as the historical to the kind of the obvious, this is yielding less or this is yielding more, because there's a lot more to it than just that rate of return.
Okay, now what else is interesting about it, Brad?
So first off is we're finally diving in, I think, and this is what I think we did an excellent job in building up for our clients, is figuring out how to fuse different asset classes to really get the benefits of diversification, and being really thoughtful around how the different asset classes that we use carry risks that other asset classes might mitigate. And so a really good example of this, and this might surprise people, but this portfolio that we're using in a cash plus is it actually has close to right around 30% equity exposure. But it's coming from stocks that are sort of call them more stable. So large cap equities, value oriented, meaning a lot of the growth on those equities is going to come from dividends that have historical stability. These are long-standing companies that have paid very consistent dividends, and that's a quarter to a third of the total portfolio, which means there's some serious growth coming from that in the last several years, and that growth is going to continue into the future. But of course, you think about it on a month-to-month or quarter-to-quarter basis, that very small allocation to equities it's not going to be directly predictable like a savings account, and that's why we have to have the other 70% of the portfolio or allocated to asset classes that we've really specifically configured to help offset or mitigate some of those risks of the equities. So you start to get into, for example, a market neutral or an equity market neutral allocation that we're using from, it's a BlackRock fund in particular that we found was just a really good diversifier or stabilizer of the yields that we wanted to see out of this. And that's like a third of the total portfolio is this market neutral fund from BlackRock that, as I said before, I don't love rates of return because they average out and you really got to understand the time frame. But I will latch on to this particular fund's annual dividend of, Brian, hold your breath. I don't know how much you dug into this already, but 10.48% is the annual dividend on that. And the way that it generates that is what's really cool. It falls in the category of an alternative asset class. This isn't like high yield junk bond category. It's a tactical model that BlackRock has out that is focused very much on the dividend. Now, that is great on the dividend front, but that's just another third of the portfolio that we have underway. The real safety, the extra The other, call it 30 to 40% that we have in this portfolio is from extremely low volatility fixed income. So, for example, we have 0 to 3 month Treasury ETFs in here right now, yielding right around 4%. That is expected to come down. But when those come in with their very near term stability, 0 to 3 months, 0 to 6 month certainty around those funds, it really does offset and balance out the risk that some of the more volatile holdings that they have in here for stocks and bonds. And we'll get into the stats more in just a second, but that combination of mixture of different asset classes, the inclusion of what is not stocks or not bonds, known as an alternative, and then of course using some short duration fixed income. It's kind of been the winning formula for this model we're rolling out for some of the shorter term portions of our clients' assets.
Brad, how about other parts of the plan? As an independent company, we're quite the contrast of the pie chart with accumulation strategies where you in your 20s, 30s, 40s, 50s, no big deal if the markets drop 30 or 40% because your income's coming from work and every 2 weeks, you're putting new money into your 401k. So you're dollar cost averaging into a down market. When the markets recover, you actually benefit. But when you're retired, your portfolio that you're drawing income from, when that goes down 30 or 40 or 50%, and you're drawing income from a portfolio that's down, that is rough. That sends a lot of people back to work. So on the other hand, we have about a 70-30 portfolio where 70% of the portfolio is principal guaranteed. You cannot lose money. Brad, go into the 4 key reasons that we draw from laddered principal guaranteed accounts.
Well, let me finish. Because you're spot on. What you were saying there is right in line with this portfolio that we have. Because I actually like the way you always say that in your savings years, it's all about dollar cost averaging. It's about how much you can put away whenever you can, and in fact, you have the downturns being your best friend. But in retirement, when you're doing the opposite, when you're harvesting, pulling money out of your savings to live life, the exact opposite is true. Those downturns are your worst nightmare and become extremely toxic. And so I think what we do really well is we're extremely thoughtful about drawing from laddered principal guaranteed accounts, extremely low volatility or no downside volatility allocations that make for very stable, consistent income through any investment climate. And I was talking about rate of return earlier. One of my favorite kind of the opposite of rate of return in terms of how useful it is something called upside downside capture. And that's what I think this cash plus model does. And it's a really good example of where I think our plans are good. It's where our plans are particularly good is we're so sensitive on our client's behalf to protecting the money that someone's accumulated. And one of the follow-on effects of not losing is that when markets are good, your portfolio doesn't actually need the same growth on the upside because you're not in an environment where you're having to recoup those losses. I've loved the bull market of the last several years. It's been super productive for my clients. It's been really nice, but I always am reminding them that these yields are, while not typical, they are needed because that's how you get to long-term averages. And those averages will have markets that are equally as bad. And with this cash plus portfolio that we can use now as some of the shorter term portions of the plan, this upside downside capture, that a little over 6% that I was talking about, Brian, the way that that's done, and I'm actually got a graph up in front of me that I wish I could show everyone. It has dramatically outperformed much riskier portfolios, like a 50-50 blend of stocks and bonds, way higher risk. And we're it's obviously outperformed some of the lower risk options that are out there. And it's because on the upside, this portfolio captures, let's say, I have a comparable strategy of like 50% stocks, 50% bonds. If that portfolio, that benchmark portfolio, was up 10%, this cash plus model captures about 6.4% of that. Now, I know that's some math that's hard to visualize if someone's driving or listening, but if you can picture if a 50-50 benchmark portfolio is up 10%, Cash plus historically is expected to be up 6.4%. All right. So it'd be a good year for everyone all around. But on the downside, actually with that upside portfolio, sometimes people might say, oh, that's a bad rate of return on that cash plus portfolio. I could have gotten a 10% yield on a 50-50. And here I am suffering through a 6.4%. But this is where it earns its keep. On the downside, if a 50-50 portfolio is down 10%, right? Pretty modest downturn, not a fun environment, but we've been there before. The cash plus portfolio would only be down 3.3%. That's huge. From a financial advisor kind of math-based approach, that balance of capturing only a third of the downside of a comparable portfolio, but keeping 2/3 of the upside, it's music to my ears. That's the kind of strategy that indicates very good long-term returns, low volatility, and intended to be set up for good, solid, stable yields in a portfolio that is drawing from safe money.
And to learn more about the upside downside capture, do you kind of like the sound of that or like to learn a little bit more? You can always call the team at Decker Retirement, 833-707-3030, 833-707-3030. When you come in and sit down with the team at Decker Retirement, they're going to help you create a retirement plan if you become a client. And income, investment, taxes, healthcare, legacy planning, Social Security, Medicare, all those decisions you have to make. But that plan is going to adjust as things change, which is why they're talking about the Cash Plus portfolio, upside downside capture. Things are always evolving. If you'd like to talk with the team, give them a call, 833-707-3030. More with Brian and Brad right after this on Safer Retirement Radio.
Your story is unique, and so is the legacy you leave behind. Connect with Brian Decker at 833-707-3030 to start writing the chapters of your legacy and ensure it reflects your values and dreams.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio. I'm Mark Elliott here with Brian J. Decker of Decker Retirement Planning. Also with us, of course, is Brad Geddes. You can always learn more about Brad, Brian, and the team at DeckerRetirementPlanning.com. You can also go on that website under the heading of Safer Retirement Education. 12 different things you can download, including Brian's book on retirement, the Decker Approach book. All of that is available to you, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. 833-707-3030. If you'd like to learn more about the Cash Plus portfolio, the upside downside capture that Brian and Brad have been talking about. Now you guys are going to venture into the world of the magical, the mystical. Huh, Brian? AI. Isn't that magical and mystical? I don't understand that world.
AI has changed a lot of things in our lives, especially in retirement planning. And if your agent advisor is not showing any big difference in the planning or the tools involved, that would be a major red flag, because we're seeing here, Brad, I'll talk about the principal guaranteed side. You talk about the changes that we're seeing on the risk side. On the principal guaranteed side, on the 7 and 10-year principal guaranteed accounts, those buckets 4 and 5 for us, instead of, now remember, the S&P in the last 100 years is averaging about 9%. In the last 10 years, the AI indexes, which are indexes that allocate hourly between stocks, bonds, and commodities, average annual returns for the last 10 years on one of them is 17.75. Another is 23.67%. Here's some more. We have 1, 2, 3 others. The 1 year is averaging 12.05. The 2 years averaging 14.23. Another's 1 year's and averaging 10.09. Another on the 2 year, 11.73. And the last index on the 1 year averaging 16.62, and another one at 21.65%. I've been doing this for 40 years now, and I've never seen returns like this. I've never seen index returns, principal guaranteed, averaging double digit in my career. So AI, if you're not aware of this, you need to be aware. CD rates right now for 5, 7 years are around 5.5% at best. You're looking at principal guaranteed accounts that need to be part of your portfolio. We're looking for three very important things. One, that their principal guaranteed cannot lose money. Number two, best rate. And then we're talking about not just 2 times the CD rate here, we're talking 3 and 4 times the CD rate here. And then the third thing that we look for is being able to pull income from them on a monthly basis with no fees, no penalties. Those are the three things that we look for. And now they're available, and they are generation 4 principal guaranteed accounts using AI indexes. These are available. We use them. We are fiduciaries to our clients. We've done the homework. We use the database that lets us see what the highest earning principal guaranteed accounts. If you're settling for principal guaranteed accounts that are just earning 5 or 6 or 7% anymore, you're leaving a lot on the table because these AI indexes are averaging much higher. Brad, what would you add to that?
Yeah, I think AI is really just changing a lot for us as financial advisors. And from my end on the compliance side, for me is it's super exciting seeing everything is coming down the pike. And so to have these types of indexes available for safe assets, already approved, ready to go, it's pretty great, because there's definitely aspects of AI that are unknown where can't be using like a black box to invest your clients' assets. And so as soon as we come across something that we can actually roll out to our clients, being an expert in the area, knowing that this is available and bringing it to our clients, I think has been really neat to be able to dig into for the last year and a half since this effort really started for us.
Okay, Brad, well, share with us what you're seeing, how AI is changing the risk side.
Yeah, on the risk side, I always divide what we do into the active and then the correlated side. And on the active side, this is where the two-sided models are just are kind of custom made for the data mining that you find, statistical investment strategies, statistical based investment strategies, momentum, trend following, as we talked about in the past, sector rotation, these things where you're not necessarily determining the fundamental value of the asset. You're looking at the direction that the market seems to be implying it wants to move. And when I think about it like that, that's just a ripe for the picking for not just a human, a statistically oriented human, but AI. And that's what we're seeing. I mean, with the algorithms that we license, while we've rolled them out internally for us to start our own research, but just getting those results back, I think in the next month or so, Brian, you think we'll have some results back of the AI assisted strategies on the active front for two-sided models?
Yeah, we should have those models any day, Brad, with the AI enhancements.
That's great. That'll be fun to roll out in the investment committee. So the AI enhancements, and I think from what we've learned so far is that their improvement is really on the timing of entries and exits, the ones where you go back and previous model data had been tuned to like a monthly entrance or exit, and that being optimal, but using AI pointing out that it's more like 2 times. Some pretty neat insights that have a material impact, at least on the data, and actually having it live in the wild with company money is going to be a fun one for us to see. Remember, I divide the risk bucket or risk strategies into active, which is what I just described with the two-sided models, and actively generating yield in the market with different techniques that you can use are well tested and with historical standing. But on the other side, the more correlated side, this is also really exciting. I mean, there's whole asset classes that are being generated or enhanced with the prospects that AI brings. Now, to be fair, I do think that there is a very, very real chance that this these AI valuations are a bubble that will need to pop to let the dust settle a bit before we actually figure out what the value is going to be and put that on a 0 to 3 year time frame. We could easily see a correction, even an extreme correction in these valuations as they are getting in an area realm of value that, as we know, it's all the way back 2007, 1999, and then even back as far as 1929. And so very real possibility of things coming back down to earth at some point. But I think in the medium to long term, say we get out 3, 5, 7 years, there's a lot of promising developments in the area of, say, energy infrastructure. Super exciting to see how much value is being created because the demand for energy there and the way we do it in a way that is least impact on the environment. Pursuing areas things like nuclear, huge. I also think that on AI front, just the efficiency that we're going to see manifest through things like corporate earnings. Going to be watching that really carefully. And that will be a huge boost to stocks in the long run, or equity investments in the long run. So some pretty cool things happening on that front, both asset class specific, industry specific, and then also just coming down to just overall efficiency. And then that's even without getting into the whole new sectors that are going to be created as a result of AI. So I think when it comes to risk strategies, it's one of the more exciting areas of being a financial advisor right now. I think exciting does come with unknowns and not really super clear how this is all going to shake out, but it definitely is an exciting time to be out there and having funds available and divided up into a holistic plan like we offer our clients, where our clients can actually take risk with their funds and have the reward pay out over their 7, 10, 15, 20-year time frame that we need them to have their plans be successful.
Now, Brad, I'm going to add more to the changes that AI has made to our momentum models. Now, the reason we're using momentum models is we're not sure, but there's been 4 times that the S&P 500 has traded above a market valuation of 30 times trailing earnings. Once was 1929. Markets were flat for 17 years. Second was 1964. Markets were flat for 18 years. The third was 1999. Markets were flat for 14 years. The fourth time was November of 2021. We hit 32 times trailing earnings. So with history, 100 years of history, we expect that markets, once they've hit this level, every other time in the last 100 years, there's a high probability that markets will be trading flat for the next 10 to 15 years. If that happens, there's 2 ways to make money in a flat market cycle. One is dividends. So we will be using the dividend strategy as a sleeve into the momentum strategies. But the second is the way the momentum strategies work is, especially using AI, is the model buys into whatever sectors and stocks that are going up in a down market. For example, in 2000, 01, and 02, the S&P was down 50%, NASDAQ was down 70%. And during that period, there were many sectors of the markets going higher. Real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, healthcare, all went higher, nicely higher over that 3-year period. You would not have known that most people lost half their money. Then in 2008, Treasury bonds were up over 20%. In 2022, when the S&P was down 19%, NASDAQ down 33%, bonds down 20% in 2022, anything energy related was higher. So the way that you can make money in a down market is using momentum strategies, and momentum strategies enhanced with AI, like you said, Brad, optimizes the trades per month. When during the day to trade, it looks at new positions. How many is the optimal positions in a portfolio? This was a biggie. When the VIX, the volatility index, is above 20, you don't put new positions in the portfolio. VIX being above 20 means that the markets are going down. Don't repurchase old positions that were bought within the last 6-8 weeks. They found that when these things were done, just these minimal things were done, the average annual returns improved from 14% a year to 32%. There was a reduction in drawdown or loss. But what's very interesting is they used NVIDIA to model the characteristics for AI for the perfect momentum stocks so that the AI enhancements in the model portfolio knows what to look for, what relative strength scores to buy into. And that was interesting. The highest relative strength scores didn't give the highest returns. So now, as a result of these AI enhancements so far year to date, we're seeing gains per trade of 2.8 times what it had before because of AI enhancements. Now, these are things that should be rolled out any day is when what we're looking for, Brad. We're very, very excited about that.
So again, if you'd like to chat with the team at Decker Retirement about anything that's on your mind, whether it's your portfolio, you want to learn more about the Cash Plus portfolio, the upside, downside capture that Brad was talking about in the last segment. There's just a lot going on. Tariffs, the debt. We're paying about $3 billion a day in interest on the debt. So if the Fed does lower interest rates, maybe that's a good thing. But there's just a lot going on, and it'd be really nice to have a plan. Those that are concerned about outliving their money, it's because they've never sat down with a retirement planning team like Decker Retirement. 833-707-3030 is the number. No cost for this chat, no pressure, no obligation, no judgment. If they can help, they'll tell you. And if you want their help, maybe you guys will work together. Don't really know, but if you have questions, get some answers. 833-707-3030. 833-707-3030. Back to wrap up today's conversation. We got a lot to get to yet. We're talking a little bit about the risk bucket options. Stay with us. Brian and Brad back with more of Safer Retirement Radio right after this.
Uncertainty in the markets doesn't have to mean uncertainty in your financial future. With the right approach, volatility can be an opportunity. Let Brian Decker and the team at Decker Retirement Planning help you navigate market changes. Call 833-707-3030 today.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Brad Geddes of Decker Retirement Planning. Again, you can go to the website, DeckerRetirementPlanning.com, find out about events that are upcoming at the various offices. All that information is on the website, DeckerRetirementPlanning.com. Also, under the heading of Safer Retirement Education, there's books and useful guides that you can download. It's just there for your information. There's no cost to do so, including Brian's book on retirement, the Decker Approach book. If you have questions, you want to actually sit down with the team. You're like, holy cow, things are moving pretty fast. I'm not really sure where everything is going. Tariffs and the interest rates, will Jerome Powell lower them and all that kind of stuff? Give the team a call and have a conversation. Maybe put your nerves and lower your stress level. Put your nerves at ease, hopefully. 833-707-3030, 833-707-3030. And Brian, it really seems to me with everything going on, we had the Liberation Day when Trump had his big chart of all the countries and here's what we're going to do. And the markets obviously hated that to start with. Then the markets really had a nice bounce back. And now we're kind of thinking, woo, Jerome Powell might be lowering the interest rates. The jobs report wasn't great. There's just a lot going on. It makes kind of people nervous. But when you create a plan for them and you walk them through that safer retirement process, there's no possible way you can put a plan in business today for retirement in the next 30 years and you'd never have to change it. You've got to be flexible, I think.
Got to be flexible. You've got to be overseeing the portfolio as things change. There's one portfolio that can make money in a lower interest rate, declining interest rate environment. There's a totally different portfolio that makes money in a rising interest rate environment. So in inflationary periods, it's more commodities, oil, gold, silver, things like that. So it's kind of interesting well, it's very important to have to do business when you're in your retirement years with a fiduciary whose job it is to make sure that you're protected in this way. Brad, how are we nimble? How are we adapting to the different changes in the markets?
Yeah, for sure. And this is one of, I think, the best parts about having a plan-driven portfolio or a purpose-driven investment strategy that's so just distinctly different than what most advisors are using, which is a risk tolerance-based investment strategy. Those pie charts that put 30, 40, 50, 60, 70% of people's assets into bond funds that just blew up in 2022, those were based on a client's declared risk tolerance. And I think that that's just a completely, it underserves clients when they're signing their names by a strategy that says, yeah, I am willing to take this much risk. And the purpose driven strategy that we use does a couple of things really well. I think what it does is it pays close attention to liquidity. It makes certain that when funds are needed for, say, cash flows, distributions, you have strategies that either are laddered out maturities with guaranteed yields, but that provide the liquidity for cash flow when needed. But the flexibility that can come from, say, cash plus on the safer side, or the flexibility that comes from liquid assets that you could sell in the risk bucket is also very much an aspect of an area that we can be flexible. We can be in a position to make changes, either slowly or abruptly as the market kind of demands. Back to just the valuation metrics that you were bringing up before. You have the trailing PE ratios, but also forward PE ratios well above historical norms. And market timing would lend itself right now to say not a good time to be in the market. But if we followed the market timing approach towards managing a portfolio, we would not be doing very well by our clients, because when you're trying to time the market like that by reading the tea leaves, you end up missing out, or perhaps mistiming a downturn and not getting back in. So to me, when you think about having a nimble portfolio or a strategy that's very flexible, there's some really good ways to go about investing money in a risk bucket. And I think of it as like valuation conscious strategy. So this is when things are really highly valued like they are right now. That would naturally lend itself to people thinking, I need to go to cash. I need to sell out. But the fact is that's not the case. And in fact, markets can stay irrational, right? They can stay irrational for a really long time. And you don't want to miss out on that irrationality. You can do things like a staggered entry. Okay, so if someone right now is in a correlated strategy and they really like the opportunities that are going to come around from having AI-driven two-sided models that we offer, well, you don't have to cut over all at once. You do a staggered entry. It's kind of like dollar cost averaging, but making a shift over time within the portfolio. Very good with a valuation-conscious investment strategy mindset. Another example is diversification. You mentioned, Brian, some of the asset classes that do well in inflationary environments, or asset classes that are going to do great when interest rates are declining, or as AI does a good job and over the 3 to 20 year time frame changes a lot of industries. Well, the fact is diversification gets you exposure to all of it, and trying to pick the winner in any given year has proven to be near impossible for all but maybe 5 humans in the history of the market. And so diversifying a portfolio to have the benefit of whatever the winner is in any particular year has been very well proven to be a good strategy for the long run. But I think really, to me, what it comes back to is this just layered income planning driven approach. Super, super crystal clear of the timing on when funds are needed. You don't take risk with short-term money. You protect on medium-term funds and ensure stability there, but pursue higher rates of return. And then where you have the longest investment horizons, the 7, 10, 20-year investment horizons, invested for growth, pure growth, and hopefully that layered approach gives people the peace of mind that any money that doesn't have exposure to volatility for when things are a lot scarier than they are right now, that's when it's time to add more. And that flexibility is what's allowed by that risk bucket.
So, Brad, in the last 4 minutes of today's show, let's summarize the cash management portfolio that we're rolling out for our clients. It's brand new.
Yeah, it just I think is a perfect example of what a good fiduciary is doing for their clients on a regular basis. We talked about the market history from 2020 all the way back to today, 5 years later, and the different market regimes that we were in and how we shifted recommendations for clients' safe but liquid funds. And now we're about to start to see that reversal begin. And while I do think rates ought to be lower than they are today, I certainly have enjoyed the interest rate for free money in the last 5 years and positioning those dollars to try to retain as much growth as possible, but minimizing the amount of exposure that they have is what that cash plus portfolio is going to do really well. I think especially as things get scary, I mentioned a little bit bubble territory for those valuations we're seeing in the market. Sometimes it is a client's wish to just sit and be in a holding pattern for a bit. And models like this allow us to do that without causing too much damage to the long-term growth of a portfolio, even if it is just somewhat temporary. And doing that staggered approach of easing in and easing out is a good way to not try to act too abruptly with a portfolio that's intended for the long run. And I think just overall being really conscientious around liquidity, anticipating when funds are needed and what they're going to be used for is such a good way to think about how to allocate funds and letting that purpose-driven portfolio drive the investment strategy, keeping in mind liquidity, highest rates of return across safe assets, both fixed and variable rates, and then, of course, pursuing your best rates of return in the most growth-oriented, longest-term sleeves of someone's capital. That's the winning formula for a solid retirement plan.
Okay, Brad. So that's a great summary. And I've just the last minute and a half or so of this program, I would just have people write down there's 6 key points to a good, solid retirement plan. One is to have a plan. Most people don't. One is to have a plan, a retirement plan. It shows your income sources. It shows minus your taxes, lets you see annual and monthly income. It allows you tax planning. Number 2, tax strategies to minimize your taxes. Have you looked at all of them? You need to be comprehensive here. Number 3, do you have risk reduction? Eliminating interest rate risk, no bond funds, minimizing your exposure to risk, and strategically lowering your risk by allowing you to have your risk portfolio make money in up or down markets. That's number 3. Number 4 is optimizing every part of your portfolio. Does your person do that? We do at Decker. Number 5 is optimizing your monthly income. If we are minimizing your risk and taxes and we're optimizing your portfolio, by default, we are optimizing your net of tax monthly income. And finally, number 6, fees. Most people charge 1% in the United States. We charge only on about 25% of the portfolio. 75% of the portfolio typically has no risk. So our typical net fee on the portfolio is 0.3, savings of 70% of what most people pay. Yeah, those are the 6 key points to look for in a rock-solid retirement plan.
So if you'd like to learn more, really, how does this affect, myself and my family? How do I figure all of this out? Everybody's situation is unique. Some people need 20 grand a month, some need 3, right? And everybody else in between. The team is here to help you. 833-707-3030, again, is the number. No cost, no obligation for this. Might be the most important phone call you make, certainly today. 833-707-3030. 833-707-3030. Brian, Brad, appreciate the time. Enjoy the rest of the weekend. We'll do it again next week.
Thanks, Mark.
Yeah, thanks, Mark. We'll see you later.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.
Uncle Sam might need a loan soon from you. We have over $36 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.